Let's assume it's your 18th birthday and you want to start investing. You got your first job and you want to set aside money for your retirement. We are going to have some rules over here. So first is that you are investing until age 65. It can only be a portfolio made of 10 individual stocks. It must be diversified, so no overlapping, growth potential, not 100% tech, and a decent dividend CAGR. Then after we build the portfolio, we will run some projections to see how it performs. Let's dive in. The first holding will be Mastercard. Mastercard is a multinational financial service corporation that operates a global payment processing network, enabling financial transactions across the world. It facilitates electronic fund transfers by providing various financial services, primarily through its branded credit, debit, and prepaid cards. These cards are used by consumers, businesses, and financial institutions to make payments for goods and services. So there you have it. The first one added to the list is Mastercard. The starting yield is pretty low since the company has gone up in price drastically throughout the years. Having a 25% 10-year dividend CAGR is astronomical and almost 20% in annual return average. This company is a beast and I'm glad to have selected this one as my first pick. Next one will be Microsoft. We all know this company, so I'll keep it short. Microsoft Corporation is a multinational technology company that develops, manufactures, licenses, supports, and sells computer software, consumer electronics, personal computers, and services. It is one of the largest and most influential technology companies globally, known for its software products such as the Windows operating system, the Microsoft Office suites, and the Internet Explorer and Edge web browsers. Adding Microsoft to the second spot does not disappoint. It is an amazing business to own. Looking at the dividend yield, it's sitting at 0.92%. Same situation as Mastercard. Due to price appreciation, the starting yield is very low. Microsoft still brings a solid 12.55% dividend CAGR and a 26% average return on the last decade. For the third spot, let's get into healthcare. Unitedhealth Group is a diversified healthcare company that offers a range of products and services throughout two distinct platforms. United Healthcare, which provides healthcare coverage and benefit services, and Optum, which provides information and technology-enabled health services. Unitedhealth Group operates in the United States and internationally, serving millions of individuals and businesses with its healthcare offerings. Unitedhealth Group has a starting yield of 1.31%. What impresses me the most is the 21% dividend CAGR. For a company in the healthcare sector, this is an impressive compounding amount. Also looking at the 10-year average, we have 22.78%, which is another huge return. It does have some risk like any other company, but being within the healthcare just adds another layer of risk. Number 4, we have Kroger. Kroger is one of the largest retail companies in the United States and the world's largest supermarket chain by revenue. It operates as a retailer of various foods and non-food items through a network of 2,700 supermarkets and multi-department stores. It has a starting yield of 2.63% with a CAGR of 14%. Kroger is one of the upcoming supermarkets that has the potential to be the next Walmart. They are expanding and opening new stores, sales are growing, and are shareholder focused. 10% is the average stock performance in the last decade. On the 5th spot, we have a worldwide recognizable brand, Hershey's, one of the largest chocolate manufacturers in the world. Hershey's is a simple yet strong business with an easy to understand operation. They just sell chocolate and salty snacks. That's it. This defensive company has a starting yield of 2.50% with a CAGR of 9.39% and 8.88% in their 10-year performance. Not market-beating return, but not so bad either. In my opinion, this is the best of the best within the consumer defensive. Then we have a garbage company. So garbage that it brings market-beating returns. On the 6th spot, we have Waste Management with a starting yield of 1.81% and a CAGR of 6.73%. The returns of the company are 15% average in the last decade. Despite having a slow growth dividend, this company overall performs pretty good. They're currently expanding and upgrading to new efficient machinery, and this could be one of the reasons why the CAGR is low. However, this is a defensive position. It has decent returns, and someone always needs to pick up the trash. For me, this is a good buy and hold for decades. Next up, we have, in my opinion, the best bank in the US, if not in the world, JP Morgan Chase. Current yield is 2.84% with a 10.70% CAGR. The return of this bank is 12.87%. It is one of the best banks due to being one of the largest and part of the Federal Reserve. The government would not allow JP Morgan to fail. Personally, this is the only bank I would own. However, every bank has similar risk, but some smaller banks have bigger impacts. For example, banks rely on customers not pulling their money out, especially in large quantities. This is called a bank run. Banks are businesses that run on trust and available liquid ready to be reinvested. Company number 8, we have S&P Global, a leading provider of credit ratings, benchmarks, analytics, and data to the capital and commodity markets worldwide. Its services are widely used by investors, financial institutions, corporations, and governments to assist risks. S&P Global's products and services are considered to be essential tools for understanding and navigating the complexities of the global economy and financial markets. This company is a powerhouse when it comes to the stock market and fundamentals. It has a starting yield of 0.99% with a CAGR of 12.39%. Its 10-year average performance is 20.14%. This puts S&P Global with the big boys like Microsoft and Unitedhealth Group within this portfolio. Now we have a semiconductor company, Texas Instruments, with a starting yield of 3.40% and a CAGR of 16.59%, just shows how this company brings massive return to shareholders. Similar to its CAGR, it has a 16.18% 10-year performance average. Despite being in a highly competitive sector, TXN always finds a way to innovate through the latest semiconductor technology and maintain a dominant market share. For me, it is a good addition to the 10 stock portfolio. And finally, stock number 10, AbbVie. AbbVie is a global biopharmaceutical company known for its focus on discovering, developing, and commercializing advanced therapies and pharmaceutical products. I know, owning this company brings a layer of risk related to health. Research for new developments can go wrong, constantly high R&D, patent expiration, and the list goes on. I do believe in their work and research to bring excellent pharmaceuticals for current world problems. Now, AbbVie brings a 4% starting yield with a 13.98% CAGR and a 13.93% 10-year return average. It has a high yield due to the recent market drop, but looking at their fundamentals, they are doing great and have room to continue expanding. So there you have it, the 10 stock portfolio that at 18 you will buy and hold for decades. Remember that this is not considered to be an all-weathered portfolio or the optimal way to invest. As you grow throughout your investing journey and expand your knowledge, changes to your thesis or fundamentals of the companies mentioned can change throughout time. I must admit that most of the companies mentioned, I consider them of good quality within their sector, and I believe that they will do well for years to come. At the bottom of the chart, marked in yellow, we can see the average yield of 2.10% portfolio average, a 10-year CAGR of 14.30%, and a 10-year performance average of 16.64%. These are the average values of the 10 holding portfolio. The yield looks good for someone starting out and having a long-term horizon ahead. Now the 10-year performance is what I like to see, 16%. That's market-beating returns. The S&P 500 average is around 10.5%. Adjusted to inflation, then let's put it around 8%. This portfolio, 16% adjusted for inflation, will bring around 13 to 14% return. Again, always keep it in mind that past returns does not guarantee present and future returns. Let's assume we start with $0 and we contribute $100 monthly. Since we will invest until 65, this will be 47 years. And we will use a conservative return of 13% annually compared to the 16% of the portfolio that we have created. We get that at the end of our investing journey, we will end up with a little over $3 million invested. Now, running another projection with $200 monthly, this will be $6 million invested. And attempting another projection with $300 monthly, then we will get $9.1 million invested. Investing early and often with a good performance can provide massive returns. Personally, I can retire with $3 million invested. Now, remember several things. We used 13% as a conservative number instead of 16.64%. To keep in mind that 13% annually is market-beating returns. Beating the market is difficult, but not impossible. Another point is to always do your own research, even though this portfolio looks solid. Never follow what others are doing or saying on the internet. And lastly, this is not the ultimate winning portfolio. There's plenty of good companies and ETF that you can invest and achieve your financial goals. So that will be it for this video. Let me know your opinions in the comment section below. Please subscribe, it helps the channel grow. Thanks for watching, and I'll see you in the next one.